My special guest on a recent episode of the Michael Yardney podcast was Robert Kiyosaki of Rich Dad, Poor Dad fame. What you're going to be watching now is the video of that interview. Now, I know Robert's views have changed many people's ideas about money and about finance, and I realise a major financial shock like the current environment the pandemic's created has revealed how many Australians just don't understand the long-lasting impact of their financial decisions that they're making on a day-to-day basis. So I spoke to Robert on my podcast last year at the beginning of the COVID pandemic when he warned Australians about the challenges for our economy ahead, the opportunities that he saw that could be coming out of a downturn, and the economic crash that he was foreseeing. Now, I didn't agree with everything I said, but I respected what he's taught not only me, but millions and millions of people about the basics of financial literacy, so I was keen to hear his opinions then. Fortunately, Robert's dire predictions didn't come to pass, so I was pleased when he reached out to me again recently to be on my podcast, so I could ask him what the biggest surprise was for him over the last 12 months. Now, you're going to hear how Robert's teachings challenge conventional thinking about money and how he suggests you should be doing what 99% of people aren't doing. I hope you're going to enjoy my chat as we talk about some of the basic financial concepts before we get into the deeper topics like what's ahead for our economy, why he thinks we're going to go into a recession, how deep the recession is going to be, but also how great the opportunities are going to be ahead once we get through this downturn. Now, you're going to hear Robert speak positively about Australia's opportunities, but you may be shocked by some of his predictions, some of his thoughts about what's going to happen before these opportunities are going to arise. Now, as I've said, I don't agree with all of Robert's thoughts, his ideas about real estate and his forecasts, what's ahead for the economy either. But rather than debating him, I'm going to give him the airtime he deserves, and then, after our chat, I'm going to share my views. So don't panic if you hear some of Robert's extreme thoughts. But please listen to the whole show, including my thoughts, and then you're going to have both sides of the argument to make your decision. I'm sure you're going to enjoy my chat with Robert Kiyosaki of Rich Dad, Poor Dad fame. For years, Robert Kiyosaki has been one of the most respected voices in the world on growing wealth. He's the best-known author of Rich Dad, Poor Dad, and it's become the number one personal finance book of all time. But Robert's also challenged the way tens of millions of people around the world think about money. Now, I've got a number of Robert's books on my bookshelf, including the one he co-authored with Donald Trump, or prior to him becoming president, and I regularly listen to his Rich Dad radio show podcast with his wife, Kim. So I'm pleased Robert's going to be on this podcast once again to discuss his views on what's ahead. So welcome to the Michael Yardney podcast, Robert.
Well, thank you very much. Well, I'll say Aussie, Aussie, Aussie.
Yes, I know you're an old fan of Australia. You're not new to Australia. You came many, many years ago, didn't you?
Yeah, I first went to Australia in 1972 to play rugby union. Needless to say, we lost every game. But I fell in love with the people, the spirit, and you really are the lucky country.
So, Robert, there's millions of people who have read your books. A lot have learned your financial concepts. But I know there's a whole new generation of investors listening to this podcast, watching this video, who are not familiar with you. So let's start with, who are you? Who's Robert Kiyosaki? And why should we even listen to you?
Well, the story of Robert Kiyosaki starts with Rich Dad, Poor Dad. My poor dad was a PhD. He went to Stanford, University of Chicago, Northwestern. But I was told him PhD stood for poor, helpless, and desperate, because we learned nothing about money at school. And my poor dad, although a PhD, knew nothing about money. So when I was about 9 or 10, I raised my hand in school and I asked the teacher, I said, when are we going to learn about money? And the teacher said, she gave me I thought I was back in Sunday school or something. She says, the love of money is the root of all evil. And I say, maybe evil to you, but I like to have some. And the reason was because I went to a school with a bunch of rich white kids, and I was one of the Asian kids. And it was kind of interesting because right across the street were the kids that came to Hawaii to work on the sugar plantations. And my father didn't cheat or anything. I just happened to live in the zoning that sent me to the rich white kids school. And that's when I could see the difference there. So I'm not being right or black and all this other stuff. It was just that the education is different. And that was where I learned.
So you had rich experiences from your rich dad. And I know in your book you talk about how the rich think differently to the poor. Now, last year we chatted, it was in May 2020. It was just the beginning of the coronavirus. Its effects were starting to make its way felt around the world. And at that time, you thought we were in for the worst economic downturn in almost a century. What surprised you most about what's happened over the last 12 months, Robert?
Well, what surprises me is how desperate the United States is right now, because if America spends, if the government spends $100, 60 of it is printed, 60 of it is fake money. So the U.S. is now dumping money straight into the economy, whereas before it used to go through the banking system. Today it's going straight into the economy. And that means the United States is pretty desperate, but it creates a sugar high. Everybody's happy, America's rich and all this. That's what Zimbabwe did. And that's what Venezuela did. And that's what Germany did during the Weimar Republic. So history is repeating itself, except history proves we don't learn from history.
Yes, it's true. Robert, before we get on to the economy, if I'm not mistaken, real estate's your preferred investment vehicle. And that's what a lot of people watching this and listening to this podcast are interested in as well. Is that right? Is that what you enjoy investing in?
Well, I always say invest in your financial education. You have to invest in what you're interested in. So if you like shares, and study shares. If you like options, study options. But I like real estate for two reasons. Number one is debt. I can use all the debt I want to buy real estate. And the more debt I use, the less tax I pay. So, Donald Trump and I, he's hated in many places, but he and I are good friends because we make millions of dollars and don't pay taxes legally. And people in Aussie do the same thing.
Yep.
It just depends upon your education and your proclivity, what you want to invest in. Most people should just stay in shares. Yeah, you should just stay in your supers.
So real estate is different in different countries. The underlying fundamentals are different in the US. The tax benefits are different. Are your concepts relevant to Australians? Should they be listening to you?
I've made millions in Aussie. They're the same. I own property in Bondi, Randwick, and Rushcutters Bay.
Lovely location. Clearly, you're a good investor. You know the best locations in Australia. Now, you've written many books. Let's summarize your investment philosophy for somebody who may be watching this, who hasn't had the opportunity so far to read them. What is the basis of your investment philosophy?
Well, I don't trust the government. And most of the Aussies I know don't trust your government either.
Well, it's become a very interesting time here with our various state governments. You're right. So your philosophy is to educate yourself. And I think that's one of the major things you've done for a long time. One of the concepts I learned I've got audiobooks, I've learned from them, I've enjoyed them, was the Cashflow quadrant. Maybe we could just quickly walk through this because it's important to understand where you fit in the game, isn't it?
Well, the quadrant is very simply four different people that make up the world of money. E stands for employee. S stands for self-employed or small business, like a doctor or a lawyer or a chip shop owner or meat pie owner. And B stands for big business, but B really stands for a brand, like brand. And I stands for insider. So I always invest from the I quadrant as an insider into brands. And Warren Buffett invests in brands like Gillette, Coca-Cola, and things like that. Unfortunately, most people go to the E and the S side, and the taxes are highest for employees and small business. In Aussie, your self-employed pay about 60% in tax. Employees pay 40%.
Okay. So people think it's secure on that side of the quadrant, though, don't they?
Well, it's all relative. I was a Marine pilot. I just love Aussie, but the first time I went there was to Perth. And I always said to people there, the higher the risk, the smarter you've got to be.
Yep.
When I went to flight school, the 2 years before I went to Vietnam, I knew the risk was going up because I was going into Vietnam and we had to study harder. So the mistake I made from the average punter out there is say, well, give me a low risk investment. Well, there's no such thing in the first place. Everything has risk. But what that says to me about the persons that don't want to study. So I'll just say it again. As I prepared to go into Vietnam, I had to fly farther, harder, faster, study more and all this. And that stayed with me. It's the discipline of the US military. And the reason I'm successful today is not that there's no risk. It's I am disciplined enough. I was a U.S. Marine to study more. It's the same as, let me give it this way. When we went to Aussie to play rugby union, we didn't practice enough. You guys kicked our butts.
You were young then, though. Things were different.
No, but it was the spirit of the game. And all it did was inspire me that I wanted to come back to Aussie, first of all. But we came away from Aussie better players, if that makes sense.
Robert, one of the things I initially said was that you often question traditional thinking about money and finance. And I know one of the things that you say differently to many is that your home isn't an asset. Why do you say that?
Well, you have to be able to read financial statements. It's very simple. My rich dad said, assets put money in your pocket, whether you work or not. You look at my book, Rich Dad, Poor Dad. By the way, I flunked out of school because I can't write. So it's ironic I'm a best-selling author. But every month it puts millions of dollars in my pocket. I'm a brand because that B stands for brand, big business and brand. So my books are sold all over the world. That's not a mistake. I'm an entrepreneur and a capitalist. So the money flows in every month. I also have 8,000 rental units. So every month they send millions of dollars a month into my pocket. Whereas my house, which I'm sitting in right now, is sucking cash out of my pocket. So assets put money in your pockets and liabilities take money from your pockets. So what really kind of wipes out people is they call liabilities, like their house and their 4 kids, assets. They're liabilities.
Interesting way of thinking about it.
They're expensive liabilities.
Yes, they are. Okay, let's talk about the elephant in the room. I believe you're suggesting the world's biggest financial crash is coming. Is that right?
Correct.
Why do you think that's going to happen, Robert?
That's what Harry and I are coming to town to talk about. Well, Harry and I are on the same team as that. The United States is destroying the U.S. dollar. And in 1944, the U.S. dollar became the reserve currency of the world. So basically, in 1944, the U.S. government or the U.S. Treasury promised the world the dollar would be backed by gold. And they broke that in 1971. So now they can print as much as they want. So America broke its promise to the world because they promised the US dollar would be as good as gold, but today it isn't. So I'll say it again. Today, as we speak, this is July 2021, every dollar printed by or spent by the US government, 60% is fake. 60% are fake dollars. So it puts America into a bubble. Everybody feels happy. China ships to us, Aussie ships to us. Everybody's happy as Larry, except they're drunk as skunks, on fake money.
So why do you think it's a bubble? How do you know for sure it's a bubble? People are happy. It's all going well.
Well, it's because in 2008, it bust. It was a thing called, I won't get into it, it's called a repo market.
Yep.
It's called the repurchase market. So there was a bubble in 2008, which led to the subprime real estate crash. So instead of fixing the problem, the United States, I'm not blaming Aussie, the United States just kept printing more money. So by 2016, it was going really, really high. And my friend Donald Trump printed even more. And now Biden is printing even more. And here we are in 2021. It is the biggest bubble ever blown in world history. So Harry Dent and I talk about that, but we also talk, how do you prepare yourself for what's going to come? I think that's the most important thing, because you and I are not going to stop it.
No.
But it's coming.
Can't it just deflate slowly, Robert? Does it really have to burst?
I mean, I wish it could, but I don't think so. I think we're on the eve of destruction. This has happened before in history, and it happens around every 80 years or something like that, and we're on it right now.
Well,
so
you've mentioned about a bubble before in your books. You've written about it in your seminars. You've talked about it. What's finally going to prick the bubble? What's going to make it burst this time round?
Well, I think was that saying, comes up slowly and then happens suddenly. My friend Jim Records, who's also been to Aussie, he says it's like this avalanche, and the snow keeps piling up. And it's going to take one snowflake. The trouble is we don't know which snowflake. And, when it comes down, it comes down. And it's going to come down so fast So Harry and I are going to be talking about what you do to prepare for that last snowflake.
I'll mention that link right now, but we'll leave it in the show notes, robertandharry.com, because you're going to spend time with Harry Dent and yourself explaining what's going on. But how bad do you think things are going to get?
I bought more guns.
Well, you live in the USA. We can't do that in Australia. But that's a concern.
I know. It's terrible they took your guns away.
What's going to happen in Australia then? Are we safe here? We've got different rules. Our economy's doing well. Employment's going up. House prices are going up. Now, I know they are around the world. Are we isolated here? Are we insulated from all this?
Correct. And there's good and bad to that whole thing, you know. But Aussie is really a rich country. Unfortunately, you kind of copy the US and you depended upon China.
Mm.
But China and America may go to war pretty soon, you know, over Taiwan.
Yes.
And that's the worst case scenario. So, if, you know, I wouldn't be complacent. That's all I'm saying. Right now, it's not time to be saying, she'll be right, mate. You know?
You know all the Australian sayings, don't you, Robert? So what's going to happen to Australian house prices?
I don't know. It's really hard to tell. You know, if they print excessively, which they might, you go to hyperinflation, then the prices will go up. But if it goes to a hyperdeflation, which is called a depression, will come down. So that's why the good thing about Harry and I, his solutions are different than my solutions.
Mm-hmm.
I think my solutions are more geared to Aussie. Harry and I get into we agree on what the problem is. We disagree on the solution. So that's why people should listen to Robert and Harry, and you can choose for yourself. You see, the reason I love Aussie is because I'm a gold guy. And, you know, Aussie is very, very rich in gold and resources. So you're a good country. But Harry says gold is going to crash too, which disturbs me. But I don't really care what he thinks. I'm still going to buy more gold. And I'm still going to buy more silver. You know, your Perth Mint, one of my favorite places.
You've got your own private room there, have you? Yeah. What about Bitcoin? That seems to be the flavor of the month at present, Robert.
Well, I don't know much about Bitcoin. I just know I started buying it at 9,000 US. So I'm still in the money. I stopped buying also. I bought about 60 coins. So I'm still in the money. Does that make sense to you? So a lot of times with investing, it's often when you buy. And unfortunately, what people do, as you know, they wait for the top of the market to buy, and then it crashes on them. So I'm not recommending Bitcoin, but the reason I like Bitcoin is because it's decentralized. The federal bank, the US Federal Reserve Bank, is centralized. The Reserve Bank of Australia is centralized. Centralized is Marxist, communist. It was Lenin who says centralized banking is essential to communism. And so the Fed is a communist organization. So I like Bitcoin because it's decentralized. I like gold and silver because they're decentralized. Harry likes treasuries, but his reasons are different than mine. So come and listen to what we say. Decide for yourself.
So if gold and silver are a choice of yours to retain your assets, but they don't bring in cash flow, how does that sit with what you said a while ago, that assets have to bring in cash flow?
I make about $4 million a month in income from real estate. I don't spend that much money a month.
Even you can't spend that much.
No, and my books bring out another $1 million a month. So I have assets. I have real assets. Gold, silver, and Bitcoin are like my savings.
Makes sense.
And I've never spent a gold coin, a silver coin, or a Bitcoin. But that's why I save my money. That's why I said savers are losers if they're saving Aussie dollars, yuan, or Aussie.
Okay, well, you're coming to Australia real soon. Without giving too much away before the live event, can you outline, at least at a high level, what opportunities you think will be available once the downturn occurs? Because there will be good times again. After every clean out, there's a new opportunity.
Well, let me ask this question to all Aussies, okay? If David Jones raised their prices 500%, would you go shopping?
No.
No. But if David Jones says everything is 90% off, everybody goes shopping.
Exactly right.
So I'm waiting for the crash. When when the crash comes, I'll be back in Aussie buying some Bondi Beach property.
So what should we do in the meantime? Should we sell up our assets, Robert?
Well, that's why you should come to listen to Harry and I, because our solutions are different. You know, if you're a stock guy, it's going to be a great time if you know how to short the markets coming down. I don't know how to do that. All I know is that I like to buy low and stay low and then wait for the markets to crash. I'm very excited. I'm sexually stimulated thinking about this crash.
Well, I really appreciate your time, Robert, because I think it's important to not go forward with blinkers on, to listen
Yes.
to various opinions, especially for people who've got a track record, as you and Harry clearly have. And look, while we don't fully agree, I appreciate the time you've spent with us. So therefore, if others want to understand and get a different view, and it's free, it doesn't cost anything. So why not spend the time and have a listen to Robert Kiyosaki? Go to robertandharry.com. And I look forward to catching up with you probably again in a year's time like we've done, and see what of these predictions have come true. Thank you so much for your time, Robert.
Thank you. Aussie, Aussie, Aussie.
Aye, aye, aye.
Aye, aye, aye. Thank you.
Well, I told you Robert would have some extreme views, didn't I? And he didn't let us down. Now, I'm going to give you an alternative view on two separate things: what's in store for the economy, and also his concepts of what makes a good property investment. So let's first talk about property. Robert's an ardent property investor. In fact, in last year's podcast, he told me that he owns 3 homes and 8,000 rental properties. So clearly he knows a bit about real estate. Well, maybe what I should say is he knows a lot about United States real estate, where the rules are very different, the tax regime is different, the markets are very different, and the way to invest is very different. In fact, I think even if I was to invest in New Zealand, which I don't, but it's a similar country, similar economies, even if I was to invest in New Zealand, I'd invest very differently how I'd invest in Australia. The similarities are closer to New Zealand than the USA, so you can't take the rules there and bring them here. In the past, I've explained how Australian real estate's very different overseas, but unfortunately, many overseas gurus don't get it. Our property markets are underpinned by the fact that the 10.6 million properties around Australia are in general owned by homeowners. In fact, 70% are owned by homeowners, and half of these homeowners don't even have a mortgage against their property. And for the other half, who do have a mortgage, many of them are way ahead in their payments, and many of them have paid off a significant part of their mortgage, while others have taken on more debt against their home to support the purchase of investment properties. For property values in Australia to crash, as many overseas gurus keep suggesting is going to happen, we're going to need to be in the position that people have to sell up their properties at virtually any price, but there's nobody going to be there to buy them. That's what would make the property market spiral down. But over the last year, despite the COVID-related lockdowns, despite the first technical recession we've had in many decades, and in fact we had the biggest drop in GDP in almost a century, our property markets showed their resilience, didn't they? And there isn't really a property debt problem in Australia like many overseas gurus suggest. According to CoreLogic, our property markets in Australia are worth a total of $8.6 trillion. But there's only $1.9 trillion of outstanding mortgage debts against those properties. Now, I say it jokingly, $1.9 trillion, a lot of money. But if you think about it, that brings a total loan-to-value ratio for our property markets to be in the order of 22%. There's no debt bubble here, and in general, the debt is in the hands of those who can afford it. The other argument I'd have with Robert is that he suggests your home's not an asset, and his argument is there's no income coming in, only expenses going out, and therefore your home isn't an asset but a liability. Now, if you accept his definition of an asset, something that brings in cash flow, then he's correct. But the common definition of an asset has nothing to do with cash flow. The fact that Robert Kiyosaki invests in gold and silver suggests he believes they're an asset. However, they don't bring in any cash, do they? I believe if I had $1 million in a bank account, that would be an asset, even though it would hardly bring any cash into my pocket. And I further believe if I took the money out of the bank and put it under my mattress, that $1 million would still remain an asset, even with no cash flow. So I think Robert's basic assumption that your home is not an asset, I think that assumption is flawed. How I see it is you get your income from an investment property in 4 ways. Firstly, through capital growth, then through rental returns, also from tax benefits, and then you can get it through accelerated or manufactured capital growth when you do a renovation or a development. So in my mind, It's an asset for a number of reasons. Unfortunately, though, too many people look for cash flow from their residential real estate investments, and that's just not how Australian residential real estate works. In Australia, residential real estate's a high growth, relatively low yield investment, and to try and make it something different just bastardizes it. And if you invest for cash flow, the results you're going to get are just not going to allow you to build a substantial enough asset base to give you the cash machine you're looking for in the future. When I spoke with Robert last year, at the beginning of the COVID crisis, he was concerned Australia would fall into a recession, as would most countries around the world. Now, that prediction came true, but the recessions weren't anywhere near as deep or as disastrous as he expected, because our governments have learned. They've learned their way of buying our way out of a recession. Okay, by spending money. But isn't it part of their job to prevent us losing our jobs, losing our houses? Last year, we saw a combination of monetary and fiscal policy cause an economic rebound that no one would have expected. And today, more Australians are employed than they were prior to the recession, prior to the pandemic, and there are more full-time jobs out there for anyone who wants to take them. There's no doubt we're going to have challenges due to coronavirus moving forward. It's going to create headwinds. But while Robert's an innovative thinker, and he's an expert in personal finance, he's not an economist. Now, I've been a student of economics for close to 50 years, but I'm not a qualified economist. But there are some very astute economists employed by our banks, by the Reserve Bank, by the International Monetary Fund, by the Fed, and they all see a very, very different future ahead, and nowhere near as negative a picture as some of the negative grabbing headlines that the naysayers are suggesting in the media. Australia's performed better than most advanced economies, and of course we're still susceptible to the coronavirus-induced problems. I'm not even going to discuss the potential geopolitical problems with China, but I see a number of reasons to be optimistic about our economic future. Firstly, global economic growth's recovering rapidly, driven in part by vaccines enabling the reopening of borders. There's pent-up demand, there's monetary and fiscal stimulus by governments all around the world, not just in Australia. So global economic growth is rebounding, and this is a strong driver of Australia's economic growth, Australia's exports, and that's showing up in our higher commodity prices. Another reason I feel confident about our economy moving forward is Australian consumers are going to keep spending. We've stashed our cash. Apparently there's over $100 billion of deposits in banks that wouldn't have been there in the absence of the pandemic. Currently, we've got high levels of consumer confidence. We're feeling comfortable about our jobs. Australians are feeling comfortable about their financial future and experiencing the benefits of the wealth effect, the positive benefits of the value of our houses going up, our share portfolios going up, our property portfolios, and of course, low interest rates. So Australians are keen to spend, and fortunately so are businesses who are seeing business returning, and so their profits are increasing and they're employing more people. As I'm saying, there's a number of reasons to be positive about the economy ahead rather than negative. I believe fiscal stimulus is going to continue. Australia's successfully negotiated its way through the so-called fiscal cliff. You know, the wind down from JobKeeper and the other support packages, and the fiscal stimulus is set to continue. Our federal government and our state governments and the Reserve Bank are going to do everything they can to ensure our economic recovery. They're not going to waste all that time, money, effort and emotion that's been put in so far to allow things to falter. So monetary policy is also going to remain ultra easy. The Reserve Bank's said so. While the Reserve Bank's slowly going to cut back its quantitative easing program moving forward, official interest rates are likely to remain around zero for the next few years. And then when our borders finally do open, and they will, there's going to be a flood of new migrants coming here, skilled migrants. Australia's going to select who can come in. People are going to be able to bring money into the country, take up jobs, pay taxes, and this is going to support our economy and our property markets. So where do I disagree? Kiyosaki has done a great job of making people aware of the importance of understanding how their money works. Don't get me wrong. I think the subject of financial literacy is very important. For years, through my blogs, my podcasts, my videos, I've been trying to educate as many people as possible about the importance of personal finance, about the psychology of success, about property investment, and even a little about economics. But over the years, I've been concerned that Robert Kiyosaki scared off many investors and led others a little astray with his various prophecies of Armageddon. In 2002, way back then, what's that, almost 20 years ago, he brought out his book, Rich Dad's Prophecy, where he warned the biggest stock market crash in history is coming. And since then, he's forecast 10 of the last 2 stock market downturns. Look, of course, I understand nobody's perfect, especially when it comes to market forecasting, and particularly in these interesting, very different times related to COVID. But in my interview with Robert, I found there was no real substance behind the reasons he felt the market would crash further. In fact, why we'd experience a depression other than a bunch of conspiracy theories. And one of my concerns is that his writings, which work well overseas, have misled many Australian property investors who try to use real estate investment strategies that may work well, clearly do work well in the United States, but don't work in Australia. You see, in Australia, residential real estate is a high growth, but relatively low yield investment. In other words, it's not a cash flow investment, yet many Australians who read Kiyosaki's books try to buy cash flow properties here, and then they wonder why they don't become rich like the books tell them they will. In my mind, your property investment decisions should be based on the potential for capital growth, which of course means if you're focusing on cash flow as the goal, you're not doing it right. Cash flow has a lot to do with it. It keeps you in the game, but it's not the end goal. Capital growth is. In Australia, you pay tax on the rent you receive, but not on the capital growth, and that allows you to grow your wealth faster than you would if you paid tax on that income. As I've said, I find too many people in Australia looking for cash flow from their residential investments, and that's not how property investment in Australia works. As I said, it's a relatively high growth, low yield investment, and to try and make it something different just tarnishes it, and the results mean that you're just not going to achieve a big enough asset base to give you the cash machine you require in the future. For many Australians, your home's a stepping stone. In this age of property investment where interest rates are accommodatingly low, mortgages are cheap, presently many Australians are sitting on a gold mine. So far from being a drain on the household coffer, many of us are taking the opportunity to reduce our mortgages faster, contribute extra to the continually shrinking monthly repayments, and in turn, some property owners, they're building up their equity in their homes in a considerable rate. And this is obviously being helped by the huge growth of the value of their properties. But think about it for a moment. Your home is an asset with no tax liability if you choose to sell it. But better than that, it could represent the leaping frog to hasten your climb up the property ladder. Why not use the equity in your home to buy another property, an investment property, or a different principal place of residence where you're going to be able to enjoy your lifestyle? So if you're interested in taking advantage of the strong property markets that are ahead, and sure, the property market's grown considerably this year, but there's probably still another 10% capital growth in the major capital cities this year, and another very good year ahead in property next year before the market's going to slow down. Growth is definitely going to slow down moving forward, but there's still strong growth ahead. I've just bought another investment property. I'm in the market for another one, actually a development site where I'm manufacturing my own capital growth. But if you're interested in understanding how you can take advantage of the property market, why not have a chat with my team at Metropole? We have no properties for sale, so our advice is independent and unbiased. It all will start by putting a strategic property plan together for you, helping you plan to become the person you plan to become. We work out where you are now and where you want to head, and then see, is it realistic? Is it likely? Are your current investments, if you have any, going to get you there? Or if you're a beginning investor, what you have to do to get on the property ladder so you take advantage of this once-in-a-generational property boom. And then you may choose to use our buyer's agents, property management, renovations, development services, wealth advisory, financial planning. We give you a holistic approach to property. That's what you need in this current market. Go to metropole.com.au, have a look at what we do, and I look forward to being part of your wealth creation journey.